With so much going on, let's start off our conversation by how you're viewing this. What is the prism through which that you're viewing all of the volatility and news flow and responding to it?
Look, I think looking at the news flow, we know markets are moving in a very high volatility manner right now. And what we are effectively doing is looking to increase inflation hedges across our portfolios just to brace ourselves for the upcoming inflation peak that we're expecting it to go to probably about 8.5% in the next couple of months in the US particularly.
And it's really interesting to me that physical gold has a part in the portfolio at the moment for you.
Yeah, look, we've added an additional overweight to physical gold, and the reason is obviously it's less volatile. It still provides sort of a hedge to the tail risk in the volatile world ahead that we're looking at. And finally, obviously, falling real rates are historically the most consistent driver of gold. And so I think it's almost that put protection that's offering us, and so that's why we've gone overweight within the gold space.
You know, this isn't such a what are you doing today, look at all this volatility in yen, et cetera, kind of question, but it's an important one to me because I think a lot of equity investors are trying to figure out if they should jump on the kind of bullish train that we see reemerging in the U.S., it seems, led by tech. You're talking about looking at defensive, high-quality stocks with companies who have a strong dividend policy. You know, in a way, dividends seem to be so, oh, that's so old-fashioned or something, right? So what exactly are you looking at?
Sometimes it pays to be a little bit more traditional when the markets are, a little bit, I would say, upside down as where we look today. I think going the long game, I think what we've seen most investors do is, try to time the market, obviously panic sell in times of volatility. And ideally, when you're positioned in such investments, quality names, long-term holds with a stable, consistent dividend flow, that plays out through this volatile time. In addition to this, I must add that we are also looking to add commodity producers just because we think that, these commodity producers outside of Russia are going to capitalize in terms of making up for the loss of supply from Russia that we're expecting ahead.
You know, the government in China, their recent decision, their statement that they wanted to get over this, this tech reform as quickly as they can was such a positive signal. It spurred, some nice big moves there. You are positive on China, and I want to ask more broadly, because there's so many people in the U.S. who say China is basically an uninvestable market. Why are they wrong?
No, I think I guess China being one of the two largest economies in the world, you definitely can't ignore China. But having said that, when we look at China, there's two ways, right? One is the economic side of things. Yes, they are looking to target, very optimistic GDP growth of 5.5. With the outbreak, we think that they have currently that they're facing, we think that's going to be softer, 4.5%. But then when we look at the valuation side of things, given the recent sell-off we saw in the tech space particularly, we think there is significant value here. Again, within the companies, within those sectors, we want to look at those companies that have, quality, strong cash flows, strong cash balances, shareholder value, and the rest. Having said that, more recently with the FSDC policy announcement, we have to really see if these policies are effectively implemented in the coming weeks. And that's a key thing that we're focusing at.